Good morning. Marc Ostwald from ADM Investor Services International with some thoughts on the outbreak of the coronavirus spread and how it's impacting the global economy and monetary policy expectations and indeed financial markets. The comparisons that we make with 2002, 2003 in the SARS outbreak may be valid in terms of the spread of the virus, and we know now that we've got actually more cases of people being infected than we did then. But in terms of its impact on the global economy, and that's very, very uncertain until we have a clearer idea of when it starts to be contained, which could be the middle of February, it could be the end of February, it could be beginning of March. The problematic is how it impacts the Chinese economy and how that in turn impacts the demand for a lot of raw materials. So this first table really just to highlight how much bigger China is as a consumer of raw materials around the world, be they energy or metals, or indeed semiconductors, or consumer, or cars, or PCs. It just gives you a very good overview of how much that has grown and how important China is to global growth. So let's move swiftly on, because this is having an impact on rate expectations. We've pushed back quite sharply in the United States. The Fed had been trying to signal, and did signal this week, that it wants it would rather like to keep rates on hold throughout this year, but nevertheless, markets are now discounting a rate cut by the end of the year. And it is largely, in my personal opinion, flow-driven, and we'll come back to that point a little bit later in the presentation. More importantly, what those rate cut expectations, heightened rate cut expectations do is have an impact on the US Treasury yield curve, which is my third table. I've just taken the overall table there from Bloomberg just to highlight that we now have an inverted curve again between the front end of the curve, i.e. the T-bills, and all the way out to the 7-year. That creates problems for the Fed in terms of money markets, which they haven't completely got under control, as Mr. Powell said this week. They hope to end a lot of their special operations, be it permanent open market operations or term operations, by the beginning of Q2, but that's far from guaranteed, and this will certainly exacerbate some of those problems. So we also had the Bank of England meeting yesterday, which is interesting. That we come to my fourth table on rate expectations there. And as we can see, we've pushed back quite sharply relative to the pre-meeting expectations that there would be a cut, if not yesterday, then at least in March. It's unsurprising the bank has now become somewhat more ambivalent on it, and also suggested that if things recover, that it actually might, the next move in rates might be a hike, though quite far out. My final chart is to do with this whole business of flow, global money supply flow, all the injection of funds that we saw, particularly in the back end of last year, basically increased the global money supply via central bank injections. And as we can see, that plays out in a very strong correlation between the global money supply and the performance, for example, of the S&P 500. What we can also see is we're starting to see a little bit of a drain now, and that may be another factor, apart from the coronavirus, contributing to the slightly weaker sentiment towards equities.